Right, it is 11 o'clock. We can get going. So, very slightly different format this week. As usual, I'm going to run through the news. And then we've got an interview, which is our China-India panel. Because of the time differences between here and Asia, we had to pre-record this. So that was recorded early this week. So I'm going to run through the news, and then we're going to play the video of that. If you do have questions that aren't answered in the video, by all means put them into YouTube chat, and me or one of the other analysts will try and answer them for you. So please bear with us while the video loads, which will be after my news segment. So without further ado, let's run through the week's news. So two things that I pulled out, Bellevue Healthcare and HydrogenOne. Bellevue Healthcare first. As you can see, not particularly great performance and widening discount until they decided they were going to implement a zero discount policy. And as we've discussed before, the effect of that has been to shrink the trust dramatically. And something needed to happen. So on the 7th of August, they announced a strategic review. They kept the zero discount policy going while that was going on. At the time, the market cap was 158 million. If you go back to the previous slide, you'll see it's now down to 145. That's despite the fact the market's gone up and the assets have gone up. So the NAV's gone up. The thing is still shrinking. And on the 17th of October, they were starting to run out of pushing to do buybacks. So they said, please, can we extend that? And there's a meeting to approve that on the 6th of November. And the messaging that I had around that was, it's got to stop shrinking, otherwise nobody's going to want it. So please block that. But now we have got at least the result of the strategic review, and that sort of advice is no longer particularly relevant. So they're going to put Columbia Threadneedle in as the new manager and change the name to CT Healthcare Trust. And they've got an existing fund called Seligman Healthcare Spectrum Fund, which is a hedge fund based in Cayman. And this is going to become a UK listed version of that. So hedge fund has got a combination of long positions and short positions where they sell stuff they don't own. It's got a definite small and mid-cap bias to it within the healthcare sector. The existing trust pays dividend out of capital. There's no decision yet whether this one will. It probably doesn't really make sense for it to. So that might upset some people. We'll see how that goes. Normally, I'd be saying, because this is such a dramatic change, you need to offer shareholders a cash exit. But they're still running the zero discount mechanism. So if you did want to sell, you can just sell in the market anyway. The sort of timetable started, but until they publish the circular, we don't know when the meeting's going to be. So it might take a while for this to get done. And obviously shareholders might vote it down, but we'll see what happens. So this is the chap who's going to be running it. This guy called Costa Clayman. He's got all the relevant experience, used to work within biotechnology firms, and has been working for Columbia Threadneedle since 2020, which isn't particularly long. And that hedge fund, as we'll come on to, has not been running particularly long either. But he has got a team of about 8 sector specialists behind him, so that's a reasonable size. It's not as big as somebody like RTW or the OrbiMed guys, but it's still a reasonable size. Still going to be a global fund, but there's a very definite bias within the existing portfolio to the US, and I think that's probably going to carry on going for the foreseeable future. So there could be some emerging market exposure in there, but it's unlikely to be massive. And it's the whole gamut of the healthcare sector, so not just biotech, but medical devices and managed healthcare and all the other bits and pieces too. Now, the idea of doing a long-short strategy, they say, is because there's quite a big dispersion of returns between the winners in the subsector and the losers. And this is something actually that Polo have been saying in their latest things, because, obviously they're doing the rounds now too, to try and to get people to roll over. So this dispersion is real. It is there, obviously, but can you pick both the winner and the loser to make the money? That's the question. So these numbers here are talking about how it's going to be positioned. I'll show it to you on a chart in a second, which makes a bit more sense in terms of the gross and net positions. We're talking about 40 to 80 long positions and 40 to 80 short positions. The long positions are a bit bigger, probably, than the short ones. not massive bets on anything. So nothing sort of bigger than 4%. So this shows you how that works. So the lower limit of the net exposure was 0. So basically, if you've got 60% in longs and 60% in shorts, then net of that is 0. But gross, you've got 120. And on the other end of the scale, if you've got 107 long, 57.5 short, you've got 50% net exposure and a gross exposure of 165. And those are the kind of bounds which it's going to operate within. So hopefully that makes sense. Now, it hasn't been going very long, as I said there before, but it has done very well over this sort of relatively short time frame. So extremely well relative to the indices that they've got there. They haven't got a benchmark index. It's not benchmarked against MSCI or Wealth Healthcare or something like that. It probably should be. If I was writing on it, that's probably what I would use. But they've used 2 biotechnology indices, and obviously we know biotechs have been done very well. But nevertheless, it's still relevant. But they've also got that small cap bias, which is probably why they've used the Russell 3000 healthcare index. So yeah, I mean that all looks good. I mean the big question is, will that persist really? If it does, they can earn decent money because there's a sizable-ish management fee, but there's also a chunky performance fee. So 15% of the outperformance of 3 months SONIA, which is the benchmark, it's like the old LIBOR. So not particularly challenging hurdle rate. Subject to high watermark. So if they make money and lose money, they've got to make back the money that they've lost before they can earn on the fee. So that's a good thing. It doesn't say it's capped anywhere in what I've read so far. That might be in the circular. We'd obviously probably prefer if it was, but we'll see. Some people hate performance fees. Some people don't mind them. Sort of whether it puts people off or not, I don't know. To the extent that there are costs in implementing all of this, Columbia Threadneedle are going to offset those against its fee for the first year at least. So that's helpful. Now, I've already said the fund's too small, so they want to grow it as fast as they possibly can. So they're saying they're going to issue stock in big monthly chunks, so bigger than the normal average market size. And because sentiment won't necessarily all be going the same way, they're also going to provide exit opportunities once a quarter. They'll be capped at 15% of the trust, and you'll be able to get in at a premium and out at NAV less costs. So that sort of works for everybody. The zero discount mechanism will stop. Probably it'll run up until the general meeting when they actually had to vote on this, but but it'll stop after that. But they will still do share buybacks, aiming to keep it around a 5% discount as a kind of maximum. So yeah, we'll see why that works or not. I just go back to the slide. For me, I would watch and wait and see what happens. I think it's an interesting idea. It's very different to anything else that we've really got access to in the market at the moment. We haven't really had hedge funds in the sector for proper hedge funds like that. So interesting. We'll see what happens. And if we can get them on the show, we'll try and get them on the show. HydrogenOne, not a great success story. Cap's just 33 million now, but that's because of that discount of 71%. And part of the reason why that discount is so wide is because everybody thinks the nose coming down, including me. So if you run the clock back on this one, at the end of December last year, there was quite optimism around the fact that it was going to get the manager was going to get bought by Cordiant. They were going to try and find some more money. The underlying companies need money. That was a big tick in the box. They thought they had enough money to run through to the end of September anyway this year. So we weren't too pessimistic about it. Then as we go through the year, they got to a point where they decided to sack the manager and appoint Redwood instead. And then because we Redwood said we're going to do a new NAV, they said there's big uncertainty around the valuations of some of these investments. So we can't publish the interim accounts, and so the shares have been suspended since the 18th of September. And then what we got this week is the publication of the circular, which just basically puts all the mechanism in place to do the managed realization, including issuing B shares to return cash. So we've got that's when the vote's going to happen now. But there's a bit more info in that about what's been going on in the background. So the cash problems within the fund are serious. I mean, it basically couldn't fund itself, let alone the underlying companies. And the underlying companies need cash funding too, because they're startup businesses in most cases, and they naturally they consume money until it all works and off we go. So the board went to see a whole bunch of these companies without having the previous manager there, and there's a kind of implication. I don't know. Basically, the impression that I got from it was that the previous manager put something of a gloss on the situation and basically made it out to be better than it was. And the board said it was really evident that doesn't matter how great these businesses are, they all need funding, and it's getting harder to get that. So that obviously impacts the valuation of these things, and this is probably why we're going to see a big fall in the NAV. So, all disappointing, very sad. I still think, I mean, I picked HGen as one of my sort of potential things for the year. And from where the price was at the beginning of the year, we might still see some upside if it all comes back. For the moment, it looks it's only going one way, so we'll see what happens. So they did have 1.2 million of cash at the end of August. They've probably got enough money to keep them going till early next year. They are looking at possibly borrowing some money against the proceeds of sales as a way of funding the thing. So that's something that we'll just have to take on the chin, I think. They are hoping to publish the interims and the new NAV within the next couple of weeks, and then it'll be able to restart trading again. And then the meeting to approve all this is on the 1st of December. So if you're a shareholder, please vote. So that is all from me.